Next, let's look at the income statement and taxes. The income statement tells you, in any given period, what you've earned and what your expenses are. That matching principle that generally accepted accounting practices talks about says that it's very important to match the revenue and expenses at the time the expenses are paid and the time that that revenue is earned. What that means is the word profits, that's a really vague term, and I'm going to try very hard not to use the word profit alone. Let's look at the different kinds of profits there could be. Gross profit. Revenues or sales minus the cost of goods sold or direct expenses. Things like labor expenses, material expenses. Well, then there's also operating profit. We have gross profit, but then we've got other operating expenses. Things like overhead expenses, the salaries of the top executives, advertising expenses, R&D expenses. That gives us our operating profit. Well, then we're going to have pre-tax profit. Operating profit plus or minus non-operating income or expenses. Well, what are those? Usually we're talking about interest expense. That's usually the biggest and often the only non-operating expense. Non-operating income, sometimes a company has a ton of cash reserves and they're earning interest income on their cash reserves. Then finally, net profit, pre-tax profit, or earnings before taxes minus taxes, and that gives us our net income or net profit. Just to give you an example of how vague this can be, when I was in Austin, I was the expert witness in a case. A man who ran a Taiwanese branch of a company had a management contract that said he was going to be paid a certain percent of the profits. Well, what profit? Gross profit, operating profit or earnings before interest and taxes, pre-tax profit or earnings before taxes, or net income. The salary and the bonus that he would be paid was hugely, hugely dependent on what the profits were. So again, it makes a very, very big difference. Another example, I bet many of you have looked at Priceline.com, maybe even bought some airline tickets or hotel rooms there. They match flyers with empty seats and people who want a hotel room with empty hotel rooms. Priceline, which by the way is doing everything completely legally, reports the full value of the airline ticket as revenue. The company says it owns the ticket, which it does, for a few nanoseconds, claims that it is liable. It's not just a commission-generating agent. Now, in my opinion, Priceline is a commission-generating agent, and that its real revenue is the commissions. Priceline says no, and everyone has agreed with them. In my opinion, that means Priceline is overstating their revenues by 6 or 7 times by reporting the full value of the airline ticket or the hotel room as revenue. Another example, a company called MicroStrategy closed a customer deal, 3-year deal, and they reported all of the revenue immediately. The Securities and Exchange Commission said this was wrong. MicroStrategy had to restate their revenues. The company lost 90% of its market value in the restating of those revenues. So that was a huge difference, and again, it shows how important understanding the accounting numbers are. Expenses, we've got the same kind of thing. The basic definition of an expense is that every time you decrease an asset because you have used that asset in revenue-producing activities, that's an expense. So we want to record all the times that we have decreased assets or increased liabilities because of a revenue-producing activity. Typically, we'll have cost of goods sold, the direct costs, other operating expenses, and depreciation. And once again, you need to know how a company is accounting for these numbers. As an example, there was a company called CD Now. Quarter's about to end. They send out $10 off coupons. So if you buy $50 worth of stuff, you'll get $10 off. You look at that and say, hey, that's a great deal. So you Send in your $40. You've purchased $50 worth of stuff, but with the $10 coupon, you only have to pay $40. CD Now records $50 as revenue and $10 as a marketing expense. Again, totally legal, but once again, they are overstating their revenues. Amazon has what they call fulfillment costs. These are the costs of operating and staffing their distribution and customer service centers, costs attributed to receiving, inspecting, and warehousing inventories, packing orders, and responding to customer inquiries. Now to me, that sounds like cost of goods sold. Amazon is in the business of taking my order for books, getting those books, packaging them up, and sending them off to me. They don't actually produce the books. They're not a book publisher, but they do get the books and then send them to me. They said no, that's not cost of goods sold. They said that's their overhead expense. So as a result, they had a huge gross profit. Now, once you got down to the bottom line, everything was accurate, but it made it look like Amazon's business was actually more valuable than it really was.